Let's dive right into a puzzle that pretty much defines our economy today. We're seeing corporations make absolutely record breaking profits, the stock market's flying high, and yet for so many of us, our paychecks feel like they're just stuck in place. How on earth can both of those things be happening at the exact same time?
You know the feeling, right? You're driving to work, you hear on the radio that the Dow Jones just hit another all-time high, but you're just thinking about how your own salary is barely keeping up with groceries. That feeling, that disconnect, that's exactly what we're going to break down today. So, if you look back over the last few decades, you see these two completely different stories playing out. On one hand, you have wages for the average worker just flatlining, barely moving. On the other hand, stock prices have gone completely vertical, just shooting for the moon. So, what is causing this huge and honestly growing gap? Now, a lot of politicians, and not just Bernie Sanders, are starting to point their fingers at one big idea: the rise of corporate monopolies. The argument goes that a few massive companies have gotten so powerful, so dominant, that they can basically write their own rules and set whatever prices they want. But, is it really that simple?
To really get to the bottom of this, we've got to jump in the time machine, because this whole story really kicks off back in the 1980s.
It is really hard to imagine this now, but back in the early 80s, corporate profits were actually at an all-time low. It was not a great time to be a big company. And then something changed. A huge shift happened. Profits didn't just bounce back a little, they absolutely exploded, blowing past every single record that came before. So what in the world happened? Okay, so the first big piece of the puzzle is this economic idea called economies of scale, and it got put on steroids by the digital revolution. All it really means is the more of something you make, the cheaper it is to produce each individual one. And a huge part of that comes down to what we call fixed costs. Think about it this way. What's the difference between a small shop making handcrafted furniture and, say, a company that builds airplanes? Well, the furniture maker has pretty low startup costs, some tools, a small workshop. But to build even one airplane, you need these gigantic factories, years of R&D, just massive, massive upfront fixed costs. The more planes they sell, the more they can spread those huge initial costs out, making each plane cheaper. This creates this giant wall, this enormous barrier to entry that makes it almost impossible for a new competitor to even get in the game.
So, back in the 80s, you had two giant forces that just poured gasoline on this fire. The digital revolution made those upfront fixed costs even bigger, which favored the huge companies. And at the exact same time, globalization was pushing every business to get as big as possible to compete around the world. But here's the million-dollar question. That explains why companies got bigger, sure, but it doesn't explain why they got so much more profitable. What's that about? And that brings us to the next chapter in this mystery. I mean, in a healthy, free market, shouldn't those giant profits attract a flood of competitors who would then drive prices back down? So why didn't that happen?
The legendary investor Warren Buffett put it perfectly. He said his goal is to own a castle with a moat around it, something to keep all the competitors out. Once a company builds that moat, it can pretty much act like a monopoly. It can set its own prices and just rake in these incredible profits without any real fear of competition.
So, how did these companies build these unbeatable moats? Well, it turns out there's a kind of playbook with three main strategies. First, you've got network effects. Think about it. A social media app is totally useless if none of your friends are on it. That makes it nearly impossible for a new app to get started. Second, hey, if a scrappy competitor does manage to pop up, you just buy them. Think Facebook buying Instagram. And third, the actual rules designed to prevent all this, our antitrust laws, they were weakened a lot, starting, you guessed it, right back in the 1980s. Now, this all sounds amazing if you're an investor, right? But what's the cost for everybody else? Well, this huge rise in corporate market power comes with four pretty big and kind of hidden costs for the rest of the economy. First, and most obviously, we all end up paying higher prices for stuff. Second, when there are fewer companies competing for workers, overall wages get pushed down. Third, it actually creates more wage inequality. Companies will pay a fortune for a few superstar employees, but they can suppress wages for everyone else. And finally, and this one's a bit sneaky, you actually get less innovation in the long run because startups either get bought up before they can grow or they get squeezed out of the market entirely. And this is maybe the most important chart of all. You see, for decades, there was this deal, this link. As companies got more productive and made more stuff, workers shared in those gains through higher wages. The lines went up together. But right around the 1980s, that link was just broken. Productivity kept soaring, but wages for most people just flatlined. The gains all started going somewhere else. Okay, so that all sounds pretty grim, I know, but here is the genuinely good news. This is not some law of nature, it's not irreversible. There are actually clear, proven policies we could use to bring back competition and start leveling the playing field. Maybe the absolute simplest way to think about a real solution is to start treating our economy more like we treat a sport, with a clear set of rules that are designed to make the game fair and competitive for everyone. So, what does that actually mean in practice? Well, it means having clear rules of the game. It means having an impartial referee, that's the government, who actually enforces those rules using antitrust laws. And it means designing a system that encourages competition instead of choking it out. It's really just about bringing back the kind of pro competition rules that actually worked really well for our economy for a long, long time. And one of the most powerful tools for our modern digital age is this idea called interoperability. The goal is simple. You separate the network itself, like the train tracks, from the service that runs on top of it, like the train company. Just imagine if you could use your favorite messaging app to send a message to a friend on a different app. That's interoperability. Right now, online, we live in these walled gardens. You can't send a message from WhatsApp over to Telegram. It's impossible. But now, look at how high-speed rail works in Europe. The train tracks are the shared network, and that allows competing train companies from Spain and France and Germany to all run their trains on the exact same line. That is interoperability in the real world, and it works. And what was the result when they introduced that real competition? Get this. Within just 9 months, ticket prices on those train routes dropped by an average of 28%. I mean, that's real proof that these kinds of policies can have a huge and pretty immediate impact on people's actual wallets. So that really brings us to the final big question. The solutions, it seems, are out there. We have a playbook for how to create an economy that's more competitive and probably more fair. But the real challenge isn't economic, it's political. Can we actually make these changes happen, or is the influence of today's corporate giants in our political system just too strong to overcome? And that's really something to think about.